72%. That's how often the S&P 500 has delivered positive returns during one specific 7-day window every single year since 1950. We're talking about $2.1 trillion in gains created during the exact same week, the last 5 trading days of December plus the first 2 days of January. Wall Street calls it the Santa Claus Rally, but it's not magic, it's mechanics. And in 2024, that pattern broke for the first time in history. Today, I'm showing you 75 years of data that reveals exactly why stocks explode during this window, why it failed last year, and what that means for your portfolio in December 2025. Let's decode the Santa Rally. If you've spent any time around financial media in December, you've probably heard the term Santa Claus Rally thrown around, like it's some kind of holiday gift from the market gods. But here's what most people get wrong. It's not about the entire month of December. It's not even about Christmas week. The real Santa Claus Rally refers to a very specific window. The last 5 trading days of December, plus the first 2 trading days of January. That's it. 7 trading days. And since 1950, the S&P 500 has generated positive returns during this window 72% of the time. Now, 72% might not sound earth-shattering, but let me put that in perspective. If you flip a coin, you've got a 50-50 shot. Random 7-day periods throughout the year, they're positive maybe 56% of the time, depending on the market regime. But this specific window? 72%. That's not luck. That's a pattern. The term was actually coined back in 1972 by Yale Hirsch in his Stock Trader's Almanac. Hirsch noticed that stocks had this weird habit of rallying during the final week of the year, and the pattern held up year after year. But what he discovered wasn't just folklore, it was backed by cold, hard data. All right, enough setup. Let's talk numbers. I pulled 75 years of S&P 500 price data, every single trading day from 1950 through 2025. That's over 19,000 data points, and I isolated every single Santa Rally window to calculate the exact returns. Here's what I found. Out of 75 years, 54 delivered positive returns during the Santa Rally window. That's our 72% win rate. 21 years were negative, that's 28%. The average return across all 75 years? 1.07%. Now, that might seem small, but remember, this is over 7 days. If you annualize that, you'd be looking at insane double-digit returns. The best year on record? 1973, with a 7.43% gain in just 7 days. The worst? 1999, down 3.96%, right at the peak of the dot-com bubble. But here's where it gets interesting. The median return, the middle value when you line up all 75 years, is 1.01%, almost identical to the average. That tells us the distribution is pretty symmetrical. When the rally works, it delivers modest but consistent gains. When it fails, the losses are usually contained to the 2 to 4% range. So why does this 7-day window outperform random chance by such a wide margin? Is it holiday cheer? Consumer optimism? People feeling generous? No. It's 3 cold, mechanical forces that have nothing to do with sentiment and everything to do with institutional incentives. Number 1, tax loss harvesting. Number 2, institutional window dressing. And number 3, low trading volume amplification. Let's unpack each one. Tax loss harvesting is probably the single biggest driver of the Santa Rally, and it works like this. Under U.S. tax law, if you sell a stock at a loss, you can use that loss to offset capital gains you made earlier in the year. This reduces your tax bill. But there's a catch. You have to settle the trade by December 31st. So what happens? Throughout December, especially mid to late December, investors who are sitting on losing positions start dumping those stocks to lock in the tax benefit. This creates massive selling pressure. Stocks that are down for the year get hammered even harder as everyone rushes to the exit before the deadline. But here's the key. Once you get past December 26th, that selling pressure vanishes. The tax deadline window has essentially closed because you need a few days for settlement. Suddenly, there are no more forced sellers. The supply side of the market dries up. And when supply disappears but demand stays constant, or even ticks up slightly from year-end bonuses and portfolio rebalancing, prices go up. This isn't theory. Researchers at UCLA's Anderson School of Business studied this exact phenomenon using Finnish stock markets, which don't have wash sale rules. They found that tax loss selling is the primary mechanical driver of December price distortions. When the selling stops, the bounce is automatic. The second driver is window dressing. This is when fund managers manipulate their portfolios before year-end to make their holdings look better on paper. Think about it. If you're a portfolio manager and your year-end statement is about to go out to clients and investors, do you want them to see that you were holding a bunch of losing stocks? No, so what do? You quietly sell the losers, again, overlapping with tax loss harvesting, and you buy the winners. You load up on mega-cap tech stocks, blue-chip names, anything that performed well during the year. This creates mechanical buying pressure in high-performing stocks during the final weeks of December. In 2025, the so-called Magnificent Seven, Apple, Microsoft, Google, Amazon, Nvidia, Meta, Tesla, they make up a massive portion of the S&P 500's market cap. When fund managers window dress, they're piling into these names, which drives the index higher because these stocks are the index. Window dressing isn't as powerful as tax loss harvesting, but it's a real, documented behavior, and it concentrates in the exact same late December window. The third driver is liquidity, or more accurately, the lack of liquidity. During the holiday season, trading volumes absolutely collapse. Institutional traders take vacation. Retail investors are focused on family and holiday shopping. Desks are understaffed. And when trading volume drops by 30 to 50%, something interesting happens to price movements. In a low-volume environment, it takes way less capital to move prices. Think of it like this. If you're trying to push a boulder uphill and there are 10 people pushing it back down, it's hard. But if those 10 people go on vacation and now it's just you, suddenly you can move that boulder with the same amount of effort. Research from Russell Investments in 2025 found that December 23rd through January 2nd sees some of the lowest trading volumes of the entire year. And during these periods, even modest buying pressure, from year-end bonuses, from portfolio rebalancing, from window dressing, gets amplified into larger price moves than it would during normal volume conditions. So you've got reduced selling pressure from tax loss harvesting ending, increased buying pressure from window dressing, and amplified price sensitivity from low volume. Put those three together and you've got the Santa Rally. But here's where the story gets complicated. Because while the 72% win rate sounds great, when you break the data down by decade, you see a troubling trend. The Santa Rally is weakening. In the 1950s, the win rate was 90%. Average return, 2.07%. In the 1960s, 80% win rate. The 1970s and 80s? 70%, still strong. But then you hit the 1990s, 50%. Basically a coin flip. The 2000s bounced back to 80%, but the 2010s dropped to 70%. And now in the 2020s, based on just 5 years of data, the win rate is 60%, and the average return is negative 0.35%. Why is this happening? 3 reasons. First, passive investing. Over 50% of equity assets are now in passive index funds. These funds don't do tax loss harvesting the same way active managers do, so that mechanical driver is weaker. Second, algorithmic tax optimization. Robo-advisors now smooth out tax loss selling across November and December instead of concentrating it in late December, which reduces the bounce-back effect. And third, the pattern is known. When everyone knows about an anomaly, arbitrageurs pile in to exploit it, and the excess returns get competed away. And then we get to 2024. The year the Santa Rally didn't just fail, it reversed. For the first time in recorded history, the S&P 500 declined on every single business day between Christmas and New Year's. The Santa Rally window produced a negative 1.62% return. This was unprecedented. Even in crisis years like 2008 during the financial meltdown, or 2007 right before it, the Santa Rally produced positive returns. 6.83% in 2008, actually. But 2024? No? What happened? 3 things. First, Federal Reserve uncertainty. Chair Jerome Powell signaled a pause in rate cuts in mid-December, contradicting market expectations. That spooked investors. Second, valuation concerns. The S&P 500 had already gained over 23% for the year, and the Buffett indicator, total market cap divided by GDP, was above 200%, higher than even the dot-com bubble. Third, the Magnificent Seven tech stocks, which had carried the market all year, showed weakness in November, dropping 14% mid-month. When the tech sector wobbles and the Fed gets hawkish, Mechanical seasonal flows can't overcome that macro headwind, and that's exactly what happened. So what are the big players saying about the rest of 2025 and early 2026? As of late November 2025, the S&P 500 is sitting at around 6,849, and Wall Street's consensus targets for end of 2026 range from 7,500 to 8,000. JPMorgan, 7,500, that's 9.5% upside. Goldman Sachs, 7,600, 10.9% upside. Morgan Stanley, 7,800. Barclays, 7,500. And Deutsche Bank, the most bullish, is calling for 8,000, 16.8% upside. These forecasts are predicated on three assumptions. 1. Corporate earnings grow 13 to 15% in 2026, driven by AI productivity gains. 2. The Federal Reserve cuts rates at least once or twice more, providing liquidity support. And 3. No major geopolitical or economic shocks. But here's the thing, these are year-end 2026 targets. What about December 2025? What about the Santa Rally window we're about to enter? The macro environment heading into December 2025 is complicated. On the bullish side, you've got seasonal tailwinds. The Santa Rally still works 72% of the time historically. You've got potential Fed rate cuts. Futures markets are pricing in a 73 to 80% chance of a cut at the December 18th meeting. And you've got year-end bonus flows, which typically support equities. On the bearish side, valuations are stretched. The Shiller-Cape ratio is elevated. The VIX, the market's fear gauge, is sitting at 25.3, well above its long-term average of 15 to 18. That signals elevated uncertainty. There's also political uncertainty around tariffs and trade policy. And let's not forget, the Santa Rally just failed in 2024. Patterns can break. So when I adjust the historical 72% probability to account for current conditions, Fed uncertainty, valuation concerns, recent pattern failure, I land at a 52 to 58% probability of a positive Santa Rally in 2025. That's basically a coin flip. The pattern is no longer a reliable edge. Let me break down the scenarios. Base case, 55% probability. The Santa Rally delivers a modest positive return, somewhere between 0.3 and 1.2%. Not the historical 1.07 average, but something close. Bull case, 25% probability. The Fed cuts rates on December 18th. Volatility drops, and we see a strong rally of 1.5 to 3%. That's the traditional Santa magic. Bear case, 20% probability. The Fed holds rates, valuations continue to spook investors, and we see another reverse rally down 1.5 to 3%. When you calculate the expected value across these scenarios, you get about positive 0.2%. Barely positive. Hardly worth the risk for active traders once you account for transaction costs, which can be 0.25 to 0.4% round trip during low volume periods. So here's the million-dollar question. Should you try to trade the Santa Rally in 2025? My answer depends on who you are. If you're a long-term buy and hold investor with a diversified portfolio, the answer is simple. Do nothing. Don't try to time a 7-day window. Stay the course. The 72% historical win rate is still marginally in your favor, and if December happens to be weak, January often recovers. Trying to jump in and out creates tax headaches and eats into returns. If you're a tactical trader, or you actively manage your portfolio, my advice is this: don't trade the Santa Rally itself. Trade the Fed decision on December 18th. That's the real catalyst. If the Fed cuts, lean long into the final week with tight stop losses around the 6,800 level. If the Fed holds or sounds hawkish, reduce risk exposure and wait for clarity. And if you're a rebalancing strategist, maybe you do annual portfolio rebalancing, front-load your trades before December 23rd. Trading costs spike during the low volume period, and execution quality deteriorates. Get your rebalancing done early. So is the Santa Rally dead? No, but it's on life support. Betting against Santa is still historically a losing trade, but betting for Santa is no longer the reliable edge it once was. The market has evolved, the pattern has adapted, and as investors, we need to adapt with it. Thanks for watching. I'll see you in the next one. And remember, don't bet against Santa unless you've done the math.